Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm joined by Dan Farmer, Chief Investment Officer at MLC Asset Management. Dan has more than 30 years experience in markets and today looks after around $130 billion of funds under management. Dan, thanks for joining Livewire Markets today. Let's dive right in. I want to talk a little bit about your investment style. How would you describe it?
Yeah, thanks, Chris. And look, good to be here. The investment style, and it's really formed over, I think as you said, I've been in the markets 30 years, so it's formed through that period. I think right at the outset, I've spent my career as a multi-manager, multi-asset manager. So, I'm really about picking the strongest managers we can and investing across, a really diverse set of asset classes. So, I'm not a, CBA versus Westpac. It's really that broad asset allocation decision that I'm taking. So a couple of things that are really important to me when I sort of think about investment style and how to invest. The first is really people. When I think back over my career, one of the really good bits of advice I got from one of my early mentors was, if you want to do well in investments, hire people smarter than you. It was a bit of a backhanded compliment at the time, but I've stuck true to that as best I can. Because really, at the end of the day, investment's about having some insights, having diversity of views, and really having some constructive discussion around big investment decisions. So really strong people around me is key. I try not to be a screen watcher. I try not to get caught up in the short-term day-to-day. Taking a long-term investment view, I think, is really critical to driving long-term wealth creation. Active management's really important to me. Active management across multiple dimensions. Active asset allocation, being really active with those investment managers we select, and having active stock pickers. And finally, I think at the end of the day, investments all about managing risk. So having sort of an intelligent approach to risk taking and really making sure you're getting rewarded for the risks you're taking is critical. So to me, as I said at the outset, that notion of diversification is really important. Being really well diversified, I think, is the best way to manage risk.
Dan, we've already touched on it. You've been in the industry for 30 years. What's the biggest change that you've seen over that period?
But probably the biggest change I'd call out is just the degree of sophistication and specialisation the industry's gone through. So I started back in the early 90s, and to sort of calibrate that, doesn't sound that long ago, but I remember when email was first installed on my desktop at work, so it's a long time ago.
Yep.
And when I started, I was at a large corporate, pretty big corporate fund here in Australia. We had 3 investment managers. They were both, I had 2 investment managers. They were both balanced managers investing in listed assets, so pretty simple 2-manager lineup. 3 people in the investment team, and no unlisted investments, no alternatives. You sort of wind the clock forward today. We've got well over 100 investment managers across all of our funds. We invest up to about 25% in unlisted assets in some of our flagship funds, and a team of 47. So, really just an increase in the sophistication and specialisation of investment teams by a factor. And I think that's a good thing for clients and a good thing for our investors.
Dan, just a very quick follow-up question there. How much of it is art and how much of it is science when you're selecting from that pool of 100 managers to make your investment decisions? It's changed so much. There's so much choice now.
Yep.
What's art? What's science?
Yeah, and really good question. I think there's a lot of it is art and experience.
Yep.
So you can torture data to death.
Yep.
And we do that. We really torture the data. And a lot of that is just to make sure the managers are being true to label. If they say what they say on the tin is what they actually deliver in portfolios is critical to us. The art is being around long enough to know the individuals, how they behave, as I said, being long-term. Are they long-term investors or are they more sort of short-term reactive? What's motivating them? So I think art probably dominates science in the long run in manager selection.
Dan, a couple of years ago, IOOF and MLC came together to form MLC Asset Management. What has been the significance of that and how does it benefit your investors in particular?
Yeah, and it was a significant transaction, to just say. Insignia, or IOOF it was, as it was at the time, purchased MLC Wealth in 2021. Yep. Really significant in the sense, really what was the underlying rationale for that acquisition, and the rationale was scale. So we really believe that you need scale to be able to deliver strong, consistent returns to clients and a good level of service. So scale was underlying it, and look, I think we've really achieved that in the sense that the investment team that I look after sort of has responsibilities over about $130 billion worth of assets. So that's a good size, and that lets us do a whole lot of things. It supports a really deep experienced investment team. That 47 people I was talking about, you can't support a team of that size on small FUM. it allows us to have really good bargaining power with those investment managers. We can leverage good fees and good arrangements with those managers. And it allows us to, which I think is really important, to tailor our portfolios with investment managers. So we very rarely just buy an investment manager off the shelf, so to speak. We'll tailor that mandate to what we think their skills are and what really suits our portfolio. So scale lets us do all those things. So over the last couple of years, we've been bringing the teams together. So we've now got one investment team at MLC Asset Management, and it's really a case of bringing the best of the capabilities of those two groups together. And from where I sit as CIO, I've really been sport by choice. Both organisations have a long heritage in multi-manager investing, multiple decades each in this space. So there was a lot of really terrific, capabilities to choose from. So now we've got a single team, whether our clients are in a MLC or Sydney or IWF heritage product, it's that one team and the good strength and capabilities of that team coming together.
Thanks, Dan. I asked you to share with me your hypothetical growth portfolio so that we could answer the question how you would invest $1 million of fresh capital. You provided me with those allocations, and I want to talk through some of the key observations. First one, 50% allocated to equities, 25% each in local and global.
Yep.
That's an underweight position, and you hold some put protection as well.
Yep.
Couple that with the 5% cash that you've also got. Is it fair to say that you're keeping your powder dry for some better valuations? Is that a reasonable assessment?
You've hit the nail on the head there. Yeah, that's fair to say. And look, maybe just to put a bit of colour on that and just sort of our view, we spend a lot of time thinking about investment markets and the economy and where we're at. So, 10-second snapshot, we think inflation has peaked.
Mm-hmm.
We saw it, 9% sort of June last year. It's now 3% in the US. A lot of that fall in inflation was really around goods prices coming down, commodity prices coming down. We think the rate of change of that inflation falls going forward will be slower. We still think it'll be trending down, but just at a slower pace. Couple that with what we've seen with central banks. So likewise, we think cash rates are close to their peak. We may see one more increase. But then we think, given that view of inflation we've got, we may see cash rates hold at this level for quite a period of time and not actually see cash rate cuts until well into 2024.
Right.
So that couples up. Essentially, we think the economy will slow. We think there's a reasonably high chance of a recession next year. And when we look at equity markets, so couple that backdrop off with what we're seeing in equity markets, we just don't see equity markets of fully pricing in that risk. So value, as you say, valuations a little high. Sort of global equity valuations on a forward PE basis are up at just over 16 times. That's above their long-term average. US price earnings multiples are a long way above their average. So we just don't think enough's being priced in. We like equities, so equity's still a big part of the portfolio, as you say, just we'd be a little more cautious. We think there's better opportunities elsewhere. And holding cash is really, it's really optionality.
Yep.
So we do see pullbacks and the cash rate's reasonably attractive, sort of where it is above 4%. Doesn't hurt that much to hold it. That optionality is, we think, going to be really valuable at some point in the future.
Dan, just a very quick follow-up question there. You said a reasonable chance of recession. Is there a number that you place on that? What is reasonable? What's reasonable in your world?
Yeah, and you asked me about art and science before, and I think predicting a recession is art and science.
Yep.
Our science tells us around an 80% chance of recession in the US in the next 12 months.
Yep.
What it doesn't tell us is that a very deep recession, mild recession,
Sure.
which makes a big difference. We think more of a mild recession outlook.
Within equities, I know there are some areas that you do still like and are hunting in. What are those opportunities? What are those areas?
Yeah, and it's always a case of being selective when you've got that backdrop. Throughout my career, and I guess across both the heritages of the MLC and IWF insignia businesses, we've liked some of the areas where you can get good active alpha from managers and equities. So that's typically small caps, both small caps Aussie, small caps global, and emerging markets. Because all three of those are markets that are, we think, got some inherent inefficiencies in how they're managed. So active managers have got a happy hunting ground to try and extract some additional return. And, very importantly, active management, we don't believe in passive in those spaces. So continue to look in those areas. Right at the moment, we think they actually look reasonably attractive. Both, small caps, Aussie and global, have trailed the larger cap markets. So, Aussie small caps are up. The index is up, say, 1%, I think, over the last 12 months, where the market's up sort of 11%.
Yep.
So valuations haven't moved, so the valuations are more attractive in those spaces.
Private equity, 5% weighting, it's an overweight. What's the appeal for private equity? Often an opaque market?
Yeah, and look, private equity, again, asset class and style of investment I've really been big into over my career. And I think looking at private equity from a longer term perspective, it is a long-term asset class. So private equity really from a portfolio construction point of view, I think both gives you a lift in returns, it juices up your return profile and your growth area, and it provides some real diversification benefits to portfolios. So private equity, it is unlisted, so you want to be rewarded for that lower liquidity, and we think you get rewarded for that lower liquidity because you've got a much broader opportunity set for your managers to invest in, and they've got a lot more control over the companies they invest in. So that's the underlying premise. And I think you want a diversified portfolio as well. So I don't think you want to pick one general GP or one private equity manager. Having a diversity is important. So we've had good experience. We've got a private equity program that MLC's been running for over 25 years, so a really good track record. That's delivered nearly 14% over the last 15 years, per annum. So that's been, a really good area, I think, to add a bit of additional return to portfolios.
Dan, you're neutral on property and infrastructure. The weighting's 15%. Is that just not an area where you think you can add value right at this particular point in time?
Yeah, an interesting one, and it's an area that it's quite diverse, right? So maybe we'll just break it up quickly.
Sure.
If you look at the property part of the market, clearly it's been that commercial office story that's really grabbed the headlines.
Yeah.
Post-COVID, people going back to work, what are the rents going to be like? But I think, and we sort of agree, I'm still sort of cautious on that space. I think there's a bit more work to do in that office market, where a rent's going to stabilise. Can those offices be repurposed? But I think it's always important to step back and remember property's got a fair few different avenues to it. So things like industrial property still look pretty good. We even think big box retail looks quite attractive at the moment. Medical centres, there's some good opportunities. And maybe just to give you a really quick case study in that retail property space here in Australia, just to show this is all not doom and gloom. We bought a large format retailer out in Minchinbury, New South Wales. So think BCF, super cheap auto type clients. Bought that at 68 mil. It's been back in June 2021. It's now valued at 73.5 mil. So good uplift, and we're getting a 5.5% running yield on that. So certainly pockets of value in direct property. Unlisted infrastructure has been really resilient. We think particularly unlisted infrastructure versus listed is quite attractive still at the moment. But overall, we're seeing sort of broader opportunity set where we're holding that neutral and looking for return elsewhere right at the moment.
Let's talk about some of those areas where you think you can get a better return. High yield credit, 10% weighting, an overweight position. Allocations to private credit, mezzanine and specialty finance. The mezz space is showing some signs of stress with some of those structures potentially becoming impaired. How are you seeing the space and the risks?
Yeah, and look, you're right. The risks are increasing, and our sort of forecast of a slowing economy recession would correlate with that. But we think you're getting rewarded for that risk through the income you're generating off those assets. And really, I think you can mitigate some of those risks through the types of assets you're going into, and in our case, having really strong investment managers that are being very, very selective about what they do. So to give you just a really quick case study. We have our alternatives team, which is part of my team, invest in an area we call specialty finance. So it's things like litigation funding, legal receivables, that sort of area. We're getting IRRs off those assets at the moment of 14.5%. So really attractive returns. And the assets backing those, to your point about risk, the asset backing those credit facilities are very uncorrelated to the receivables. They're very uncorrelated to the broader economic environment. So you've got a high degree of safety there. And you just look more broadly, things like secured private debt. Here in Australia, we're getting returns of 9.5%. And here in Australia, really good covenants, really good protection, in place for borrowers out here in Australia. So we like those parts of the market. We think we're getting rewarded for that risk. Also overweight IG, short duration credit, Dan, where there are some excellent lower risk returns on offer, as you would well know. Still, it's quite defensive to be overweight these particular assets in a growth portfolio. What would you need to see, just broadly, to be more bullish and more aggressive? What do you want to see from the economy? Yeah, okay. We do like the IG short duration stuff, so we're getting good returns there. And we think, really the way we're thinking about that is, it's a good opportunity compared to some of the other risks in, say, traditional fixed interest asset classes. Now, to your question, what would we need to see to get, say, more bullish on equities. Couple of quick things. We'd like to see really at its core that earnings expectations come back a little bit. We still think, as I said before, probably a little bit of optimism about how the economy is going to be able to weather these higher interest rates. We'd want to see the economy probably stabilise or get more confident about where the economy is going to bottom out. So we're still in that process of reacting to the higher rates. The consumer's still coming to terms with those higher rates, we think. And we'd like to see valuations be priced more towards recession multiples. So as I said earlier, multiples are still sitting quite high. Australia's not too bad, but when we look at US in particular, those multiples are still, we think, quite optimistic given the environment we're heading into. So we'd want to see those multiples come back. I should say we're always reassessing, so we have a view, we're always watching the data, and I think you've got to be very careful not to get welded onto a view, so we're always reassessing, but they're the type of things we'd be looking for.
Right, Dan, let's shift focus just a little bit.
Right.
What are the main questions that your clients are asking you? What's the word on the street at the moment, if you will?
There's always a lot of questions.
Yep.
Maybe to pick one, so we just talked about fixed interest, but the whole fixed interest space is a pretty big topic with a lot of our advisors, and it's understandable. Like, you think back the last couple of years, financial year 22, fixed interest market benchmarks were down 10%.
Yeah, they're the part of the portfolio that's supposed to protect you.
And as you say, it was a nasty shock. So last year the markets were flat. So you've had 2 years where that sort of defensive, traditional fixed interest part of the portfolio just hasn't behaved how a lot of people have expected or what they've seen over a long period of time. So look, I think the good news out of all of that is that pain that we've been through has now sort of reset the sort of outlook for fixed interest. So long-term bond yields, both US and Australia, 10-year yields above 4%. Remember, they're coming up from sort of nearly zero not all that long ago. So it's been a big readjustment in yields. So that yield is now providing, those yields where we're seeing in sort of duration assets is now providing a couple of things to investors that I think they actually look for out of fixed interest. So income, so your diversified fixed income portfolio is probably yielding 4.5%, which is not a bad yield given where we're seeing inflation starting to trend, and it's providing protection again. So what I mean by that is, if we see the economy slow as we expect, inflation starts to drop, bond yields tend to fall and you get a capital gain. So that diversification protection element that we traditionally look for out of fixed interest is back, we think. So it's not to say it's a perfectly smooth road. There could be bumps along the way, but we think, broadly we're getting to a point where fixed interest starts, confidently playing that traditional role in portfolios.
Thanks for chatting with Livewire Markets today.
Thanks, Chris. Good to speak to you.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.